Steve Severaid is president of the Greenspan Company Adjusters International. He works for disaster victims so that they may get their lives in order without the added burden of assembling and documenting their insurance claim. With public adjusting licenses in over 19 states, Steve has represented victims of major losses throughout the U.S. and worldwide. And I know I have been working with these guys all week trying to help folks who are having issues, and they've been such a huge asset to the community with the fire. So, Steve, I will turn it over to you.
Thank you.
You may.
Yeah, okay, good. Because it's really hard to talk with a mask on. How's everybody today? So, thank you for that introduction. Who's ever heard of a public adjuster before? Oh, that's actually a lot. Well, Dan, I expect you to raise your hand. I mean, you work for the company. So, a little education, and it's pretty timely with your neighbors losing 1,000 homes just down the road, and that's one of the reasons we want to come and educate everybody a little bit and give some advice. And you may know somebody who's lost their home or know somebody who knows somebody, and there's not a lot of education out there. Not a lot of people really understand the process that happens if you lose your home. They say losing your home is only second to losing a family member. It's very emotional, and unfortunately, the insurance company is a machine that's set up to get started right away and hit the ground running. And oftentimes, people aren't emotionally ready for that negotiation. So there's 3 types of insurance adjusters, and for the people who know what we do, this will be a little redundant, but I think it's important to understand, because oftentimes people say, well, my adjuster. Well, that's kind of a misnomer, right? Because the adjuster that's brought out by the insurance company represents the insurance company's interest, not the policyholder's interest. So there are 3 types of adjusters. The first one's called a staff adjuster, a salaried adjuster. That's somebody like a State Farm employee who comes out and represents the insurance company. They don't have to be licensed. They don't have to have any qualifications. The second type is an independent adjuster. An independent adjuster, again, is a misnomer because they're not independent by any stretch of the imagination. They represent the interests of the insurance company. They are the eyes and ears of the insurance company. So people are often confused by that because they think it's their adjuster, that it's an independent person that's coming out. They're not independent. And independent adjusters don't necessarily have to be licensed either. Their office manager may have to be licensed, but there can be unlicensed people out there running around that don't really have the education needed to fully understand an important and complex insurance claim. And the third type of adjuster is what we do at Adjusters International, and we're called public adjusters. And I was surprised by how many hands raised because most of the time it's like crickets, because what we do is such a unique thing. We are advocates for the insured. We only represent policyholders, never insurance companies. So we're the only ones that really are on the policyholder's side through a complex insurance event. And I've been doing this for about 32 years, and I have watched our industry change over the 32 years. It used to be kind of back of the napkin exercises with insurance companies to figure out what somebody should be owed, and it's become a lot more complex. The insurance companies have taken away the authority from a lot of the adjusters. It's become a much more corporate transaction than it was when I got into the business 32 years ago, and even more need for having an advocate for you if you lost your home and you're trying to figure this out for the first time. So to get an education through the process is expensive because it's an education you'll never use again, hopefully. So that's why we exist. We change people's lives in our advocacy and make an incredible difference on how much money people get. And the money might not be the important measure, but the money dictates what you can do with your life. So the more money you have, the more options you have, the more opportunities you have. So that's a little bit about what we do. The insurance policies, just to give you a little, and I know this is the most exciting thing you can do is talk about insurance, right? It's a lot of fun. I think originally there was another guy who was going to talk about mold that was going to be here, I think, and I'm not sure. That's a tough race, right? What's more fun, mold or insurance? Anyway, so The folks that are going through this now are putting in their claim, they're getting assigned an adjuster from the insurance company, whether it's an independent adjuster, a staff adjuster, and they're now looking at the insurance policies, often for the first time. Most people never read their insurance policy. They buy it's a requirement of the mortgage or whatever, and they don't really spend a lot of time thinking about it unless they've had an experience in the past. So they're dusting that off and they're looking at it. And the way the policy's written, almost all policies are written on a replacement cost basis now. So that means new for old. And so they're looking at their policy limit on their building, and it's X amount of dollars, $500,000. There's usually another extension of coverage that gives people more coverage. So if you're talking to somebody and say, yeah, I only have X amount of coverage, you might want to ask them, do you have extended replacement cost? Extended replacement cost is additional money available beyond the policy limit. It's usually a percentage of that policy limit number. You guys all with me? Okay. Anyway, so, and then everything else goes from there. Everything else is a percentage. So a lot of people have asked me, like, how did they come up with $332,000 for my personal property coverage? And it's just a mathematical factor. So they figure out how much insurance you should have on your house, and everything from there is just a percentage. Typically 50 to 75% of whatever you have on your house is how much coverage you have for your contents in your personal property. In the wildfires, and we go to all of them, in the wildfires, the insurance companies often will do things a little differently than they do if you just have a single event and a fire at your home. They'll often give you a percentage of money up front, a percentage of your coverage A that's your building, a percentage of your contents. And they do that, partly to be efficient, but really they do that because they save billions of dollars doing it. They've got an event with 1,000 homes. They say, we'll pay you 50% of your limit for your house, and here you go. And we'll pay you 30% of your contents. And the percentages change from wildfire to wildfire and from insurance company to insurance company. But they're banking, especially on the contents, they're banking on a lot of people not wanting to go through the arduous task in front of them to assemble a personal property claim. And so what happens is it's emotional, very emotional thing, and people have, even taskmasters have trouble putting together a comprehensive list of everything they lost. What we do is we have personal property specialists that help in that effort, but when we measure it, it's down to pencils and paper clips. I mean, just think of every little thing that was in your junk drawer being listed out individually. So people, they start off on the, taskmasters, they got the couch, they've got the things that are important to them, they've got the TVs, and then at some point people sort of run out of gas and they move on with their lives and they don't really want to think about this stuff. So the insurance companies know this, so they'll give you a nice chunk of money and then say, hey, if you want more money, no problem, just put together this detailed inventory list and price it, and they hand it over to us and we'll take a look at it and maybe we'll give you more money. So there are a lot of people that just never do that. And the insurance companies know there's a certain percentage of people that won't do it. So if you are talking to somebody and they're like, well, they gave us a pretty big advance, make sure and share with them. If they don't go and do that work, the insurance company's done nothing wrong, because it's the insured's obligation to prepare their claim, to present it to the insurance company. So anything the insurance company is doing to try to, quote unquote, help you in that process, they're doing because it makes sense for them to do it. So if you do talk to anybody and they've got a chunk of money on their contents, encourage them to stick with that, because otherwise they're leaving sometimes hundreds of thousands of dollars with the insurance company. Yes, go ahead.
Does it make sense to do at least a video of your house, open up your cupboard doors?
It's a great question. It's the simplest thing to do. You can do it in 10 minutes. You save it to the cloud. Make sure you don't have some hard copy that's sitting in your house, because if your house burns down, you're not going to have the video. But it's a great idea. I recommend everybody do that. You can even do it with your phone video camera and just walk through the house and narrate it as you go through, and open the drawers of your dresser, scan in, go in the closet, scan around. Take you 10 minutes or something. That helps us. Very few people do that. But when they do that, it helps our team to take that and put it on paper. It's so much more efficient, and it's easier to prove. A lot of people ask me, well, do you need receipts when you go to the insurance company? Well, if your house burns down, the receipts are gone too. So that's not a great evidence. Sometimes we get credit card invoices over the last couple years, and we find things that way. But the videotape is, I don't even think it's called a videotape anymore, but whatever it's called now, that's the single easiest thing you can do. So I would recommend a couple things for folks who didn't lose their home. Take in a video inventory, narrate it, and also get the insurance policy out now. Don't wait for something bad to happen to see let's see what we're working with now. That's the wrong time. Get it out, dust it off, and ask the question, how much is it going to cost per square foot if my house burns to the ground? How much coverage do I have? And the difference in premium dollars is so insignificant to the amount of coverage. So yeah, you may pay a couple extra bucks to upgrade that number and get a little bigger. And a lot of agents too don't really understand. So you go to them and they say, well, we put it in the computer and that's what it came out, so that you're covered well. That's often not enough. And we see it over and over again in wildfires where people simply don't have enough money. And they've got to pull from their contents money in order to rebuild their home, or they don't get to rebuild at all. And if you don't rebuild, you don't get all of the money either. Because the way that the insurance claim works is you only get in layman's terms, the used value of your building and your contents until you demonstrate that you're going to spend the money. So if you don't build, you are going to get less money than if you do. Or you can buy a building and qualify that way too. But often insurance agents will say, well, you've got, not only do you have this amount of money on your house, but you have what's called extended replacement costs. So you're covered. Don't worry about it, because you've got another 25% or whatever of money above and beyond that if building costs are more than we expect. Well, we've seen in the last wildfires in California, building costs have shot up with COVID, the COVID protocols, the supply chain issues, everything that's going on with the shortage of workforce, lack of builders when you have 1,000 homes or several hundred homes or several thousand homes. You cannot rely on that percentage as part of how much you think it'll cost to rebuild your home if you lose it. So that should be like a bonus. Like, I should have enough insurance on my stated policy limit that I think even with contingencies, I'll be able to rebuild my home. Then this extended amount of money should be in case something crazy happens, like supply chain issues, COVID, or whatever else might happen in this crazy world that we're living in now, so that you have another cushion, another sort of insurance on the insurance, if you will. And so those are the two best things that you guys can do as homeowners to protect yourself in the unlikely event that you're faced with what your neighbors are being faced with right now. As you now know, it can happen to anybody, because I don't think anybody would have expected what happened here, especially in December, January.
Can you speak to landlord versus tenant in this scenario? I mean, tenants have their own insurance, landlords have their own insurance, and it's not clear at all to me about cleanup and all that stuff.
It's clear as mud.
Yeah.
Yeah, that's a great question. Only probably 1 in 10, and that's being generous. Only about 1 in 10 people we run into that are renters actually carry renter's insurance. And the landlord's not required to carry any insurance on your personal property if you're renting. And oftentimes, and I see it all the time with apartment buildings that burn down, and tenants are coming up and they're asking me, well, how am I going to get my stuff covered? And it's a difficult conversation, because the answer is nothing they want to hear, especially when they don't have anything left. And the best they have is Red Cross coming out to help them for a few days. So if you know anybody's renting, I'd strongly encourage them to get renter's insurance. So where does it stop and where does it start? That gives them coverage to go find another place to rent. It gives them coverage to try to take out damaged things out of the house and clean them up and restore them. It gives them coverage for the things that are completely lost. It also gives them some liability coverage in case they were at fault in any way in the fire starting. That's it. It doesn't cover them for anything else, and the landlord is responsible for his building. Does that answer your question?
So it burned to the ground, it's got to be cleaned up, the landlord's going to clean it up,
Yes,
not the tenant.
correct. Yeah.
Let's say the tenant's car is in the garage, that's the tenant's property, can the landlord really remove that burned up car?
No. If there's things there, first of all, if there's insurance for the car, then the car insurance comes over and takes over the towing of that. If there's no insurance, there's usually some agreement. Usually what we do when we're representing landlords is that we do a release form before the landlord touches anything. Even if the stuff's completely burned up, they don't touch anything until they've got entered into a release with the tenant, paid the tenant back their deposits, unused rent, all that kind of stuff. And then the tenant signs away saying, okay, whatever I wanted out of there, I've got. And then the landlord goes in there and takes the stuff. To take it prematurely is just inviting a lawsuit. Yeah, go ahead.
What about owners of townhomes and condos?
Yeah, so those are unique because the association carries the building insurance, but it gets really interesting, right? Because depending on your CCNRs, sort of the rules that are written for the condos, it may cover, the association policy may cover everything. It may only cover the bare walls. It may cover the units as they were originally furnished. In other words, whatever the flooring was or the type of countertops was when the building was built, the association's insurance policy will take care of. So there's a whole variety of ways that you may or may not be covered under the association's master insurance policy. And then you need to buy insurance that covers you for your tenants' improvements, your betterments, your upgrades. But what's really important, and a lot of condo owners and townhome owners don't do this, is you want to look at the master policy. You want to see what the master policy covers, and you want to look at the CCNRs. Those are the governing documents. In the case of destruction, what is covered under that master policy, and then you want to align what you purchase so that you fill those gaps. And that's often not done, but the very first thing the insurance company asks for when they come out on a condo or townhouse is, give me a copy of the governing documents, the CCNRs. That's the very first thing they're looking at, because they're looking at what is my liability, what can I not pay for here. And so we've seen claims where tenants have had to come out of their pocket to put in cabinets and carpet and all that kind of stuff because it just wasn't covered under the master policy, and they were under the false impression that that's what the master policy was there for. It's a great question. We have this situation often. Yeah. Anyway, what else have we got here? So, yeah, talking a little bit more about personal property, and I can't stress this enough. If you know anybody that's going through this, especially now, and they don't have a videotape, it's really important that they do some exercises, some mental exercises to emotionally kind of go through and open the drawers in their mind and write everything down, and don't just write down the things that are big and obvious. Write down all the little stuff. You'd be amazed at how much value is in your home. And, you know, a great example of that is I've talked to people all the time. They lose their home and they run out to Target or Walmart. They run out of the house and literally have nothing. They run to Target or Walmart to pick up, you know, a few things, and they spend $600 or $800 on buying toothpaste and you know, some sweatpants and just some little stuff to get them through the first couple of days after an event. And when you think about how everything you have in your house, and as you collect things over the years, inherit things and purchase things and have, you know, 50 bath towels, even though nobody needs 50 bath towels, this is what happens. You collect stuff. And when you start adding up all that stuff, it adds up to an incredible amount of money, and people really don't appreciate how much they're leaving with the insurance company because they're not thinking about the value of those 50 bath towels. So really important that they document that well. And also, a lot of people don't understand the process. And if there's anybody here who's a real estate agent who sells real estate, this is a little gem for you. People have an opportunity to not rebuild. Some people don't want to spend 2 or 3 years going through a rebuilding process, or economically it doesn't make sense for them. So you can qualify for all of your settlement money, because remember, the way you get paid on settlement with the insurance company on your building, it's not all up front. You've got to demonstrate to the insurance company you're going to spend the money in order to get the full settlement. Otherwise, you're only entitled to the used value of the improvements to your home. So take the land out of the equation. What's the used value of my house? That's the layman's way of saying, what is my actual cash value? And that's what you're entitled to until such time that you demonstrate to the insurance company that you're going to rebuild. And the insurance company is on that track. Okay, are you going to rebuild? Are you going to rebuild? But there is another opportunity, and we've helped a lot of our clients save a lot of time and actually get more value out of buying another property and qualifying. So here's an example. So let's say that you have, the insurance company agrees that you have $500,000 worth of damage to your house if you were going to rebuild it, just taking a number out of the sky. And you go out and you find a home. As long as you spend $500,000 or more on the improvements to the land at that new home, you can qualify to get all of the replacement cost money as if you were rebuilding. So you're just choosing to replace rather than to rebuild. So the important part of this factor, and it's changed recently in California, but not here in Colorado, you have to take the land out of the equation. So if you buy a house for $500,000 and the insurance companies agree it's going to cost you $500,000 to rebuild your house, you're not going to qualify for all $500,000 because you've got to take the land out of the equation. Remember, you still own your land where your house was. And so you've got to take the land out of the equation for the house you buy. So if you spend $700,000 on a house, and we were talking earlier, the land value is a bit of a problem here as it is in California because the land is so expensive, and you've got to take that land value out of the equation. But for example, if you spent $700,000 on a new house instead of rebuilding your house, and you had an agreement with the insurance company for $500,000, and the land is worth $200,000, so you take that out of the equation, you've qualified for your replacement cost. Why this is such a great opportunity for a lot of people is with building prices as high as they've shot up all over the place, oftentimes you can get a lot more money for a house that's already sitting there than what you'll get for your money in building a house. So from a real estate person's perspective, this is a great opportunity to educate your clients and could-be clients to say, hey, I can show you some properties to where you don't have to go through this process, and you might end up at the end of the day with more value and more equity than you would if you went through this arduous task of rebuilding. So, and a lot of people don't know that that's an option. Insurance companies they don't highlight that as an option often. And so I've known lots and lots of people have done that way and have come out the other side faster and with more equity at the end of the situation. So, yeah, go ahead.
The video tours, how often do those need to be updated? So let's say an insurance company sees one that's 2 years old, what do you recommend in terms of how often?
I think it's a good idea to do once a year. It's like checking your smoke alarm batteries, right? Just once a year. And it's, even if it was a few years old and you'd bought more stuff, it's not like the insurance companies will look at the videotape and say, well, I don't see that on the video, so you didn't have it. So it's just a guide. It's a great guide, but it's just a guide. It doesn't lock you into this is the only stuff that I'm going to be able to claim.
Thank you.
Go ahead.
So does the insurance company own the property, the land, after you take that action?
No, not at all. So you still own your land. So again, from a real estate guy's perspective, now I've got a piece of land I can sell. I got a house I can sell. And so that's why you have to take the land out of the equation on the new home that you buy too, because you still own the land over here. Therefore, they're not going to pay for the land at the new place. Now in California, they've recently changed that. And now it's hard to imagine rebuilding in California after a fire, because now they've changed that and said, we're not going to make people take the land out of the equation. So, and especially in a state where land is so expensive, like Colorado and California, they're helping you buy a chunk of land now, which is, to me, it could be a windfall for somebody. They haven't made that ruling here in Colorado, unless, Jan, they haven't done anything like that here, right? Yeah, Dan, yeah.
So then who's responsible for the mortgage payments, assuming you have a mortgage on the land?
You're still responsible for your mortgage payment. However, there is a bucket of coverage on your insurance policy. It's either called loss of use or additional living expense. So that pays you for the extra money that you're now spending while you're out of the home. So if you had a mortgage payment for $4,000 a month, you still have a mortgage payment for $4,000 a month while you're out of the home. But if you got to rent another home for $4,000, they pay the $4,000 to rent the other home. So you keep whatever your standard costs were, and anything above that, including mileage if you have to drive farther back and forth to get to work or take the kids to school, all those extra costs that you're spending while you're out of your home, those are all part of that additional living expense bucket of coverage. Yeah, but you keep paying your mortgage. Yeah. Any other questions about this process, about what people are going through, or what else you can do? Go ahead.
Is it true or false that the insurance agent can actually have a certain authorized amount to be able to cut you a check right then and there after a catastrophe?
Yeah, it depends on the agent, and it's usually direct carriers. The agents have some ability, but it's very small numbers. Compared to a catastrophic event, it's a de minimis amount of money that they can, and many of them don't have any authority to do that, but some do. But it's not a lot of money towards the size of these kinds of claims. They're good, like if you have a washer and dryer that leaks and runs some water out, causes a couple $1,000s. There are some agents that have that authority to just go ahead and take care of that, and that's what we call a nuisance claim. It's just easier to just pay it and get it out of the way. But when it comes to a major claim, they don't have really any horsepower, which is another thing that people don't understand. You buy insurance from your best friend or your brother or whatever for 20 years. So then you have a fire and you think, well, yeah, my buddy's going to help me out. He's my agent, so I'm in good shape. I'm in good hands. The reality is the insurance companies separate the sales from the adjusting. They've got a sales force out there and being the agents that are out there selling and promoting, and then they have claims adjusters that are out there counting the beans. So they have a real division of labor there on purpose, because if you are buying insurance from your brother, of course he's going to want to give you everything. They have virtually no horsepower with the insurance company and the claims departments. And a lot of people kind of don't understand that. So I always say to people, if you bought insurance from your family member or a close friend and things aren't going well with your claim, don't blame them. It's not their fault. They have no ability to help you. And I've seen friendships be ruined over this very thing. So it's really important that just because you bought insurance from a friend or a friendly agent and they're going to want to help you in any way they can, their hands are really tied. Their ability to really make a big impact with the insurance company is very little, very little. Go ahead.
You mentioned that sometimes adjusters are not licensed or certified in any way.
Sometimes, yeah.
What are the impact? I mean, if you get one of those people that has no experience and you think you're getting lowballed, what are our options? Ask for another adjuster, or?
You can do that. You may or may not get one. A bigger problem is that, well, there's two big problems that happen, especially in an event like this. You have cat adjusters, catastrophe adjusters, and they come in from out of state, come in from Alabama or something. They don't understand construction prices here. They're not well educated, and they write horrible estimates. And then the other bad thing that happens is that people go through 3 or 4 different adjusters because they cycle in and they cycle out. So sometimes it's not, can I get another adjuster? Sometimes it's like, I can't believe I have another adjuster. And then you've got to redocument everything you've done with the last 3 adjusters. So that becomes a problem. To answer your question, yeah, you can ask for another adjuster. You may or may not get it, but you can ask. This is why we exist, right? Because we do this every day. We know how to sort of play their game. And so you have the option of bringing in a qualified public adjuster to help you get through that. And we know how to deal with these unlicensed or stormtrooper guys and gals. This is what we do every day. So we can be really impactful in those situations when you're dealing with people who are clearly out of their depth. And it happens a lot, especially in a catastrophe. It happens a lot.
What is
We just like to help people. We work on a contingency fee. We get paid as and when our clients get paid. We don't get anything up front. Our incentive is directly tied to the policyholder in that we want to get people paid every dollar they're legitimately entitled to under the terms of their policy, and we want to get it as efficiently and as quickly as we can, because the better they do, the better we do, and the quicker we can get it done, the quicker we get paid. So we really have a parallel interest to our clients all the time. And I know the next question is, okay, but what is it? The industry standard for public adjusters' fees is 10%. And it shouldn't be 10% plus cost. Sometimes people do that, but it should just be, 10%. Sometimes it goes down a little bit, depending on circumstances. Sometimes it goes up a little bit, but as an industry standard, it's 10%. Substantially less than bringing an attorney who doesn't even do this. Yeah. Did you have a question? No, you had your hand raised a couple minutes ago.
That was the crux of my question. Yeah.
Okay.
So you brought up attorneys. That's a good thing to talk about what an attorney does versus a public adjuster.
Sure. So there are attorneys that do first-party property claims, which is what we're talking about, which is all we do, by the way. If you have a car accident or if you have a medical problem, that's out of our league. We have a very narrow focus. Attorneys have a much wider focus. But attorneys don't actually adjust claims. They don't have inventory specialists. They don't have building cost estimators. They're not in the claims adjusting business. They're in the lawsuit business. And so things take longer, and the way they do it is different. And one thing that I've seen over the years is the minute a policyholder hires an attorney, so the insurance company always likes to be above you in the pecking order of things, or at least equal to, right? So they bring out an adjuster, and it's you down here. They like that. You bring in an adjuster, now it's adjuster to adjuster, it's an even playing field, and they're not always thrilled about it, but that's okay. The minute you bring in an attorney, now they say, wait a minute. We've got claims adjusters here, and they're bringing in an attorney. It's the very first thing they do, they bring in an attorney. Now it's going to a whole different forum when it's attorney versus attorney. And if you guys have ever had to deal with a situation with attorneys, it tends to take a long time. And the outcomes are a little more unpredictable. So what we do is we are just making sure that they apply the policy terms correctly, making sure they stick with the insurance policy, and fulfilling the duties of the insured to properly document the claim and properly price it, do depreciation schedules. None of those things attorneys do. So it's a very different situation. Now, there are times when attorneys are needed and warranted. If you have a coverage question, if you thought you bought something that you are now being told you didn't buy, if you have a lapse, if you have a safeguard endorsement where they're saying that you didn't comply with some of the policy terms, if they're accusing you of setting the fire, there's a whole host of reasons why attorneys are important in this process. But if you know what your insurance is and it's what you expected, and it's just a matter of going through the claims process, the best thing you can do is bring in an adjuster and keep it at that level of adjuster to adjuster. That's a good question, Dan. Go ahead.
On average, how much more do you see your clients getting than the people who don't work with a public adjuster?
The difference between our claims and what we see insurance companies coming in at is oftentimes hundreds of % difference. Any other questions? So to review, we're public adjusters. We only work for the insured, never the insurance company. The best time to bring us in for advocacy is at the beginning of a claims process rather than waiting till you have a problem. And understand that if you find yourself in the unfortunate place of having to deal with a complex claim, some people will say, well, I don't want to upset the apple cart. I want to try to work with my insurance company. Recognize that the minute you have a major claim, they are not on your side anymore. And to think that you can play nice in the sandbox and work with them, you already have a negotiation in front of you. And their interests are different than yours. So the best time to get somebody to guide you through this complex maze is in the beginning to get advice. Even if you choose to try to do it on your own, get some advice from somebody who's done it 1,000 times so that you can take from that and make good decisions. Because waiting till you're at a major impasse, it's very difficult to undo the things people have done. And we have this all the time. We have people call us 3 months in, 6 months in, sometimes 2 years in. And sometimes we can still help them, but never to the degree we could have had we been able to control everything from the beginning. And oftentimes we can't help them at all because there's just too much has been done in the wrong direction. And to get it back, it's very, very difficult. So get an advocate early on. At least talk to an advocate early on because you can get such an education for your particular circumstance. God forbid you're ever in it.
Too late for these victims, 2-3 weeks.
2 or 3 weeks is really the beginning stages after something like this. Not a lot happens in the first couple of weeks. Everybody's, the community is shaken and everybody's trying to find a place to live, and the insurance companies are trying to respond also. And
Did you bring business cards?
yes, we have business cards. Yeah. Go ahead.
Steve, you're in for 10% of the policy value or the amount that you negotiate over the insurance company's offer?
It's 10% from $1 of what our clients actually collect. Sometimes we'll work on what you're referring to as what we call an overage. So sometimes when we get involved later, we get involved 6 months later, and they've gotten some money, sometimes we'll work on a larger percentage, but only on the new money that we help achieve. But I'll tell you, historically, our fees, when you do the math backwards, are a lot more in those cases than just doing it from the beginning. Yes?
I'm assuming that you guys would review a policy, like now.
Absolutely.
No, but what would you charge for something like that?
We don't charge anything for that. Yeah, we do policy reviews all the time. Happy to do them. Whether you've had an event, whether you haven't had an event, we do that kind of stuff all the time. Just to make sure that people are properly insured. If you've had an event, to coach you on some of the good and bad that might be in the policy. If you hadn't had an event, to say, hey, you might want to talk to your agent about this and this and this. Yeah.
Great, thank you.
Mm-hmm. Yes.
I was just gonna make mention that, I speak often about free policy reviews. Give me a call, I can set up an appointment, you can come in. You don't have to come in, you can just send it to us and we can talk over the phone. I personally wouldn't be doing that, but our public adjusters would be. I'm not licensed and insured. And I also wanted to make mention that, we are gonna have a different workshop series on, a speaking engagement similar to this. It's online. I have some flyers if you'd like to take a few flyers and pass them out to whomever you know. You're more than welcome to do so.
Yeah, as we definitely, in every wildfire, we put on some workshops for the victims and have various experts that we bring to them. And we'll be doing that here, and you'll probably hear some radio stuff about us, and all of a sudden you'll be like, oh, it's those guys. And we'll be in the newspaper, and we'll be putting on community events, and some of those people end up getting help. Some of the people we can't help, candidly, because if their insurance picture is such that we can't make a difference, then we switch to, let me give you as much advice as I can so that you can get through this the best you can. There's also an organization that we work with. It's a nonprofit called United Policyholders. You guys will probably hear about them as well. And they're really helpful for the underinsured people. They're helpful for people that maybe have a problem with what their coverages were versus what they expected them to be. So there's a lot of community outreach that happens after an event like this, and we help a lot of people who we never actually get paid to help, but still coach them through the process. And the ones we know that we can make a difference on, we share that with them, and the rest of them we really help for free. Yeah. Any other questions for me? Well, you've got me? No? I don't know how much of my time I've used or how much I have left, but I could go on and drone on about insurance for about 17 hours, but I don't think anybody brought sleeping bags. So,
Right at 11:30, so that's perfect.
okay. Well, thank you for your time. Thank you for listening, and hopefully you gleaned something from the few minutes that we spent together. Thank you.